You know, you reported earnings your company did a little over a week ago, and during the conference call, I believe you said we're going to pick up another 5 million barrels a day of demand. The rest toward the end of the year, we'll pick up another 2 million barrels in 22. So you're talking 8 to 9 million barrels a day. What, within a year? You still feel comfortable with that?
Yes, David, it's great to be on your show. I'm always used to talking to Jim or Brian, so it's good to be on your show for the first time. But Pioneer had a great quarter. Our recent acquisition, Double Point, added over $5 billion of free cash flow over the next several years. So we're now going to have about $23 billion of free cash flow, and we're committed to giving about 80% of that back to the shareholders. And so we're creating a variable dividend. It'll be approved by the board next February for our first variable dividend. And so we're moving away from this generation of grow to distributing over half of our free cash flow. Over half of our cash flow back to the investor base.
And is that going to change your investor base in some way, do you feel?
Yes, it has. The industry has gone through, we were mostly a growth sector, a growth industry over the last several years with the tremendous growth in both oil and gas shales. Now we've moved away from the growth sectors of the big mutual funds, and we've started to see several mutual funds that come in from the dividend and value sector starting to buy into our space. And so that's what we want long term, is those dividend paying funds that want dividends long term.
Scott, it's Morgan. I'm going to ask you the same question I asked the CEO of Freeport-McMoRan regarding copper last week. Is crude in a super cycle?
No, I don't think so. I don't think crude is. I think a lot of these rare earth minerals, copper, aluminum, they could be in a super cycle, but oil is definitely not. I'm a firm believer that with the U.S. oil industry moderating its growth, that we're taking the biggest issue off the table with OPEC. OPEC is very pleased, and OPEC Plus. And we've been in this range, $60 to $70 over the last 4 months. And I think we're going to stay in that range over the next several years. So we've taken the biggest issue off the table, and that's the U.S. oil shale growing too much, too fast over the last several years.
Yeah, just to I guess home in on that a little bit more, Scott. I mean, we have had these cycles, several of them now, really over the last decade, in terms of crude prices. And what we have seen in the past is that when the price of crude has started to recover and climb higher, so too have the rig counts here in the U.S. It seems like perhaps we're at a shift now, and certainly from a Pioneer standpoint, it seems like that, where even as the price of crude begins to climb higher, your production levels are not following suit. You're staying a bit more disciplined. How do you see, I guess, the economics around that? And does it represent a change in the way that U.S. producers like Pioneer are now operating?
Yes, Morgan, that's a perfect question. There's been a tremendous shift. When I returned to Pioneer a couple years ago, I went out with our executive team and talked to all of our top shareholders. We came up with a new plan to move forward. Instead of spending 110% of our cash flow to grow over the last 10 years, we're going to be spending about 50% to grow and limit growth to about 5% a year over the next 10 to 15 years and distribute that free cash flow back to the investor. So in the earnings call, I actually mentioned that when you look at the amount of free cash flow we're going to be generating, our dividend, once we start paying the base and the variable, when you calculate it, it's over an 8% dividend. There's no reason for this stock to stay where it is if we're going to start paying an 8% dividend. And so it's really a new game plan. I think most public CEOs are committed to that. It's going to help OPEC and OPEC Plus moderate. We're not going to capture market share away from OPEC and OPEC Plus. And so I think we're going to see, we're taking the volatility question out of the oil price environment, which is one of the biggest issues we've had over the last 10 years.
Right. Although you're still looking at what, $2.95 billion to $3.25 billion in terms of your capital budget, right? I mean, it's not like you're not going to be spending. Are you going to stick to that, though, regardless of what happens to the price of oil?
Exactly. I've made a commitment that as oil prices could, if it moves up above $70, we're limiting our growth to no increase this year. Next year, 5%. So I've been asked the question, if it goes to $80, $90, it's more money into the investor's pocket.
Shepard Smith here. Thanks for watching CNBC on YouTube.